Hey guys, this is the Successful Investor Club, the place where we educate ourselves financially and learn how to invest and not speculate. Today we'll talk about how, through the help of calculations, we can find out whether an investment is profitable and liquid, and we'll look through the income statement and balance sheet of a few companies. You shouldn't be bothered by the different numbers and percentages because they aren't that complicated. Using easy formulas, we will see whether a company has good growth and solid business fundamentals. The legendary Warren Buffett also uses these formulas for evaluation of companies. We evaluate the development of a company by going through the fundamentals of its business. The first action that investors should take before investing capital in a company are evaluating the company's income statement and balance sheet. Most investors first look at the performance of the share price and use this information as guidance for whether to invest or not. However, this is an incorrect way, and this video will explain the first steps required when evaluating a company, allowing you to multiply your financial assets. Please consider subscribing to the channel and sharing the video with a friend if you enjoy the content. Let's start the video by explaining what gross profit margin is. Gross profit is calculated by subtracting the cost of goods sold from the total revenue. For example, if you buy a car for $500 and sell it for $1,000, your revenue will be $1,000. However, your gross profit will be $500. It's gross profit because we haven't taken out the price of gas, taxes, etc. Now that we know how much the gross profit is, we need to determine the gross profit margin. This means what part as a percentage of the revenue turns into gross profit. We can find this by dividing the gross profit by the revenue. We don't want to see drastic changes in the percentage unless it is constantly increasing. This will tell us that the company starts generating more revenue and becomes more profitable. If the percentage starts dropping, this can serve as a sign that the company's management has made poor decisions. It's important to note here that we can sometimes see a significant decrease in the gross profit of a company caused by a purchase of a particular asset during the year. For example, if company ABC buys a tractor in 2021, this will significantly decrease the gross profit margin in 2021 because a part of the profit has gone into purchasing another asset. However, it will increase the company's productivity in the long term, ultimately increasing the profitability and gross profit in the future. To visualize this, let's take Apple as an example. This is a part of the income statement, and we can use it to derive all the information required to calculate the gross profit margin. To calculate the gross profit, we subtract the cost of goods sold from the revenue, which equals a gross profit margin of about $104 billion. The gross profit is always included in companies' income statement. The figure here is in thousands, which is why we say billions and not millions. In order to calculate the gross profit margin, we divide the gross profit by the revenue, which equals a little bit more than 38%, which is an extremely high margin for a company with the size of Apple. To find out the figure in percentages, we need to multiply the number by 100. Now that we know how to calculate the gross profit margin, let's calculate the net profit and the net profit margin. We can calculate the net profit margin by dividing the net margin of the company by its revenue. Again, we multiply the number by 100 to find out the percentage. In the case of Apple, we look at the income statement and we find the net profit, which is always at the bottom, and it's 57 billion. Net income and net profit are synonyms. After that, we find the revenue of the company, which is 274 billion. When we divide the net profit by the revenue, we see the net profit margin of Apple, which is an incredible 20%. We want to see the net profit margin gradually increase in time, as this will show us that the company has excellent profitability, solid management, and good business fundamentals. With the net profit margin, we should be cautious because sometimes a company increases it artificially. This can happen if a company sells some of its assets. As the company has sold some of its assets this year, its profit will grow artificially for that year compared to last year. This is artificial because this profit didn't come from new clients, instead it came from the sale of a particular asset. Therefore, you need to be cautious with significant increases in the profit margin, and you need to check what has caused it. The next calculation we have is called the debt to equity ratio, which is extremely important when evaluating a company's financial health. It shows the debt of a company compared to its capital. The obligation of a company is directly related to its financial health. With time, we want to see it decreasing, and we always want to avoid companies whose debt looks and grows like this. The ratio debt to equity is calculated when we divide a company's long-term debt by its equity, which is known as shareholders' equity. This capital belongs to the shareholders. It can be calculated by subtracting the total liabilities from the total assets, all of which can be found on the balance sheet of a company. To understand this better, let's take a look at Google's balance sheet. To find out the debt to equity ratio, we first need to find the shareholders' equity, which is always on the balance sheet, and it's the number we get when we subtract the total liabilities from the total assets. In this case, it's 201 billion. It can be found in two places, here as well. Total equity, shareholders' equity, or stock equity are all synonyms, and they all mean the same thing. Knowing the shareholders' equity and the total liabilities, we can find the DE ratio. We can find it by dividing the total liabilities by the shareholders' equity. This way, we see that Google's DE ratio is only 0.37. For context, Google has one of the best DE ratios in the whole industry. An outstanding DE ratio, according to Warren Buffett, is between 0.5 and 1. A ratio above 1 would mean that the company's total liabilities are more than its total equity, which is not ideal. In the case of Google, they have almost 3 times more total equity than total liabilities. The lower the DE ratio, the better it is, and the same goes the other way around. Using this ratio shows the financial health of a company. Now we'll talk about the two other ratios used to calculate a company's liquidity: the current ratio and the quick ratio. To find the current ratio, we need to know the so-called current assets and current liabilities. We can find them in the balance sheet of a company. To find the quick ratio, we need to subtract the inventory, which means the goods that haven't been sold yet, from its current assets, and divide the results by the current liabilities. Current usually means up to 1 year. These ratios are used to analyze the short-term liquidity of a company. This is interpreted to see if a company could pay its total liabilities at once without selling its key long-term assets and repay all of its short-term loans. We want to see a number above 1. This means the current assets are above the current liabilities. A number below 1 would mean the liabilities are more than the assets. Let's take Amazon as an example. From its balance sheet, we can find the current assets, the inventory, and the current liabilities. The current assets are 96 billion, the inventory is 20 billion, and the current liabilities are 87 billion. To find the current ratio, we divide the current assets 96 by the current liabilities 87, which equals a 1.09 ratio. The ratio is above 1, which is very good, and it shows that Amazon won't have an issue repaying its current liabilities with current assets. To find the quick ratio, we need to subtract the inventory from the total assets and divide the result by the total liabilities, equaling Amazon's quick ratio of about 0.86. This gives us a better picture of the current financial health of Amazon, as we subtract the inventory which cannot be sold in case of liquidation. To sum up, we learned that companies are not evaluated by the movement of their share price, as this doesn't provide us with the information about a company's fundamentals. We learned the base calculations used by investors. To calculate the profitability, we learned that we should look at the gross profit margin and the net profit margin. For evaluating the liquidity, which is used to see the financial health, we use the DE ratio and the quick ratio as well as the current ratio. If you enjoyed this video, please consider subscribing to the channel. Thanks for watching until the end and see you next time.